Good day, traders. Hope you guys are good and welcome to my trading space. In this video, we're going to be talking about tradability for supply and demand areas. I'm going to be giving you guys rules for you to identify areas of supply and demand that you can trade from so that you know the difference between the areas where you should be trading from and the areas that you need to avoid. Now, this is a continuation from a video I uploaded on identifying areas of supply and demand. If you still haven't checked that out, the link to that video will be made available in the description box below. Tradability is an extension from what we were talking about, in the sense that for you to have a zone that's tradable, one has to find a zone that's confirmed. Meaning, for a zone to be tradable, first it has to be confirmed. You cannot have a zone that's tradable without it being confirmed, right? And we'll go through a brief summary of what you need to look out for in order for you to confirm an area of supply and demand in a minute. And when we're talking about tradability, we're just discussing where are some of the areas where you're most likely going to find high probability trades, high probability setups, right? We're just trying to filter out all of the nonsense areas from the ones that are valid so that we can find the highest probability trades. So for revision, okay, let me do this real quick. For revision, for a zone to be confirmed, what has to happen? Let me do this. Right. There has to be a break of structure after an imbalance has been formed, right? There has to be not more than 4 basing candlesticks, right? There has to be at least one candlestick consolidating away from that right. Also, you need a strong imbalance. You need a strong imbalance. Right. So yeah, on the basing of candlesticks, I forgot to mention something last week. And I'm just gonna, I know it's gonna look messy, but this point is fire. You need a base with tight candlesticks. Right? We already discussed that we don't want dojis, we don't want candlesticks that are too wicky. So with bases with tight candlesticks, what I mean is that the wick length should not be more than 50% of the body. So these are the rules that this thing has to meet before we can confirm it. Now, when it comes to tradability, we're basically looking for these other two elements. We're looking for profit margin right? And the profit margin is basically the distance between two areas. So let me just type it out. The distance between two opposing areas of supply and demand. What else? So it's basically RR. When you're talking about profit margin, we're talking about risk to reward ratio. How do you set your stop loss with this thing? You set your entry at your proximal line. I'll put up a picture so that you can see them. And then you place your stop loss at your distal line, or a few pips below that, right? Where do you set your take profit? You set your take profit at an opposing level. Now, you only take a trade if the distance between your entry point and your take profit is 3 times the distance between your entry point and your stop loss. If you don't have this, then you should cancel out that area. So that's the rule that you need to follow. And I'll show this time. I'm going to use the trades that I've taken on Telegram, right? So this is the general rule. And then the next element that you need to take into consideration is their arrival. On this arrival, we only take trades if the market retests your area of supply demand with a strong candlestick. If you get a weak arrival upon the retest to your area of supply and demand, it means that the market will potentially break your area. That's why when I'm doing my market breakdowns, I often talk about congested price action at a significant level, right? Once you see that, most of the times it means that the market will eventually break that area. And on a lower time frame, if you look at it from smaller time frames, you'll see the general generating liquidity scenario. So often, most of the time when you see a lot of candlesticks on a specific area or stuck at a specific point, on a lower time frame, you'll see that this is what's happening, right? And on a lower time frame, it's just looking for an area where it can take liquidity. So that's why you're looking for areas where the market just goes there in a strong, leaves there in a strong way, fill in the orders, and then at the same time moves away, right? And then the last element, which we discussed in the previous video, is freshness. right? Basically, on this, you should not have, okay, the first retest, if you have a strong arrival, if you have a good profit margin, if it's been confirmed, first retest, you should place a limit order for those sniper entries. Or you can place you shouldn't, but you can place a limit order. Because these are the best or high probability. Upon the second retest, wait for candlestick confirmation. Because why? Orders are being filled gradually, right? So wait for candlestick confirmation. Now with 3 or more retests, know that your zone has been used up. So yeah, these are the things that you need to consider before taking a trade on a supply and demand area. Obviously, alignment with a higher time frame will forever be a chat. But then apart from that, if you're considering taking counter trades, which is what most people do, right? These are the things that you need to consider now. Let's go to a live chart. So I'm only going to be sharing 3 examples, the examples of which I feel like were best examples. So we're going to start with USD-CHF. On USD-CHF, I'll post exactly what I said on the right side. But basically, you see that there's an imbalance here. Let me change my color. There's an imbalance here, right? And it's resulted in a break of structure. Okay, look at the time spent away, look at the departure, look at the basic candlesticks. Everything about this pair or this setup is perfect, right? Now look at the arrival on this area. Not so ideal, but then because of the other factors that I mentioned, that's why I placed my limit order, right? Now let's look at what happened next. And immediately when the market got to that area, we got a bullish push. Now, I'm recording this on the 10th of September, right? The market for now is still in a correction. Reason why my take profit is so far is because of the time frame hierarchy that I told you about. So you have a main time frame, which is your higher time frame. You have your intermediate time frame, and then you have your entry time frame. On your entry time frame, you use it to place your stop losses and you use it to enter into your position. On your intermediate time frame, you use it to place your take profits. On your main time frame, you use that to get the main direction of the price, right? So here, the levels highlighted in yellow, they represent my daily demand and supply areas. This blue one represents my weekly. So I used my weekly as an intermediate time frame, and I used my daily as my entry time frame. So that's why my stop loss was here, and now my take profit is here. But then when I was talking about profit margin, I was talking about profit margin on your entry time frame, not on your intermediate time frame. Because this area of supply over here, although we might say it's not that valid for us to place an entry, right? It can still make the market to turn into a correction, maybe retesting this area of demand again before going up. So when I was talking about profit margin, I was talking about profit margin on the entry time frame. As you can see, there's a distance between where we wanted to enter and the opposing supply, right? That's what happened on on USD CHF. Now let's go to another pair or another example. Now we're on Euro CAD, right? Same thing happened. Now here, that's where my chart of arrival, look at this arrival, look at this imbalance over here. Time spent away resulted in a break of structure. Everything about this was perfect. Now let's look at what happened next. You instantly got a drop to the downside. And we took profits from this area of opposing demand. So yeah, this is what happens. Obviously, there's more to it because this is like the free version or the overview of what happens. We get more into what happens in the paid course, right? But then this is more than enough to get you guys going, right? So yeah, time spent away, arrival, break of structure, everything. Yeah. Now let's look at one last example. Now this is NZD CAD. We got a breakout from this trend line over here, right? And the market just taken liquidity from this area. You can see with this liquidity grab over here. Now the market was going down to retest structure, right? Reason why I had my limit orders here was because this was an area that the market left before going up. So the market was either going to reverse on this area of demand over here or here. And the reason why I decided not to place my entry on this area was because of the basing candlesticks, right? So when I compared them to this one, this one looked a whole lot better. So that's where I placed my, look where I placed my stop loss, a few pips below the distal line, right? So I was aware because of also the fact that the market could reach for possibly a discounted level, that the market could go into this higher time frame demand area. So which is why I placed my other limit order on this area over here. Now let's see what happened next. The market went, right, broken this area over here, and then we got our push to the upside. So in summary, this is what you need to look out for. Make sure that you revise everything, and this is more than enough to keep you guys going. Thank you for tuning in and watching till this point. Till we meet again, peace.